New York City, September 2008. The air crackled with an unprecedented crisis. Lehman Brothers, a behemoth of finance, crumbled. A panicked auction on Wall Street, unprecedented in its scale, was underway. The world watched, aghast. Billions vanished. Markets froze. Homes were repossessed. Millions lost savings. This was supposed to be the defining economic shock of our time. But here's the chilling twist. Was it truly over? Or did that crisis, that monstrous debt, simply transform? And if it did, where did it hide? And why does the financial instability we feel today, the inflation roaring through the economy, the market's seemingly inexplicable gyrations, does it smell faintly of that toxic soup from a decade ago? Today's story is about more than just remembering 2008. It's about tracing the mutated DNA of that crisis and understanding how its ghost haunts the financial system, hidden in plain sight. A story of broken promises, hidden risks, and the enduring fragility of our modern economy. This is the saga of the debt that refused to die. To understand how the 2008 crisis might not be truly over, we need to go back. Not just to the headlines, but to the intricate, almost surreal mechanics of the financial plumbing that created those toxic assets. It started, as many things do, with housing, or rather, with the idea of housing. In the years leading up to 2008, fueled by cheap money, low interest rates, and a relentless belief in rising home prices, the American and global housing market boomed. But it wasn't just about buying homes. It was about leveraging that home equity into almost anything. This is where the complexity begins. You borrowed money to buy a house, a mortgage. But what if you borrowed again on that house? And then again? This was called a home equity loan or a second mortgage. Financial institutions, chasing high returns, created complex instruments. They bundled these risky home loans and the even riskier second mortgages, together with other, safer loans and bonds. Think of it like this: you have a bunch of different colored marbles in a bag. Some are smooth stones, safe, some are sharp pebbles, risky. The banks wanted to sell these marbles, but no one wanted the pebbles alone. So they mixed them all up. They sliced and diced this giant, mixed bag of mortgages, tranching it, creating layers or tranches. The top layer, the safest, got the highest ratings, AAA. These were sold to pension funds, insurance companies, investors worldwide, considered as solid as bedrock. The riskier parts, the bottom tranches, were hidden. They were assigned lower, often misleading ratings, sometimes even junk bond levels. But instead of being sold openly, these riskiest bits were packaged and sold privately to sophisticated investors, often with layers of complex derivatives layered on top of them. It was financial alchemy, turning unsecured debt into seemingly safe assets. And at the heart of it all, the collateral, the actual backing for this intricate financial casino. It was the underlying pool of mortgages. But here was the kicker: many of these mortgages were subprime, meaning they were given to borrowers with shaky credit histories, people deemed high risk by traditional standards. These borrowers were more likely to default if interest rates rose or house prices fell. The system relied on three shaky pillars: rising home prices, the belief that houses would never stop appreciating, making the underlying collateral always valuable; low interest rates, keeping mortgage payments affordable, preventing defaults; infinite liquidity, the idea that banks and investors could always borrow more money to cover potential losses. It was a house of cards built on a foundation of leverage, complexity, and the relentless faith that housing prices would keep climbing forever. And then the house tilted. Interest rates started to creep up. The housing bubble, inflated to grotesque proportions, began to pop. Home prices stopped soaring and started falling precipitously. Defaults surged. Borrowers couldn't afford their payments. The complex instruments, sliced and diced, started to unravel. The AAA-rated parts, thought to be safe, began to show cracks. The underlying collateral, the actual mortgages, were failing. This is the crisis moment. Suddenly, the AAA rating wasn't enough. The complexity hid the true risk, and the leverage magnified everything. A small wave of defaults on subprime loans could trigger massive losses on the supposedly safe AAA bonds because they were all connected to the same underlying pool of mortgages. This is where the term toxic debt came into sharp focus. Not just the subprime loans themselves, but the complex derivatives and bonds built upon them. It was debt that was dead, metaphorically speaking, but wrapped in layers of financial packaging that made it appear vital and safe. The entire system, built on this intricate, high-leverage debt machine, was now critically ill. The crisis spread. Credit markets froze. No one could trust the ratings. No one knew how much risk was hidden in their supposedly safe investments. Banks stopped lending to each other, terrified of the other's hidden toxic assets. Governments intervened on an unprecedented scale, bailing out institutions and injecting trillions into the system to prevent total collapse. And here lies the core of the never-ended narrative. The subprime mortgages themselves, the original toxic debt, were largely dealt with. They were absorbed by the banks or written down. In many cases, homeowners simply stopped paying, leading to foreclosures. The complex derivatives and structured bonds were unwound, often through government assistance. But the engine that created those toxic assets, the system of complex, high-leverage debt, didn't disappear. It mutated. It didn't vanish. It just changed its form and its location. Where did this mutated debt hide? It didn't just disappear into thin air. Transformed. Some of it became standard corporate debt, sold to investors who didn't realize its hidden origins or the same underlying fragility. Some became even more complex derivatives, traded in the shadows. And crucially, the practices that enabled this debt creation, the use of complex models, the pursuit of ever higher leverage, the packaging of risk, became embedded in the new financial products. The leverage, the pursuit of yield at the expense of safety, the belief in perpetual growth, these weren't just mistakes of 2008. They became the new normal. And the debt that fueled this system grew exponentially, not just in the US but globally. This debt wasn't necessarily tied to housing anymore. It was attached to student loans, corporate acquisitions, infrastructure projects, even tech startups. But the mechanics were similar. Borrowing to buy assets, leveraging that asset, creating complex financial products, hiding risk. So what are the consequences? The 2008 crisis didn't just cause a recession. It fundamentally changed the financial landscape, leaving legacies that still resonate today. First, the erosion of trust. Credit rating agencies, once seen as gatekeepers, faced unprecedented scrutiny. Their models proved inadequate. We learned that complex products can be dangerously opaque. This distrust persists, making it harder for capital to flow efficiently and increasing the cost of borrowing. Second, the increase in inequality. The bailouts disproportionately benefited the financial industry and the wealthy, while homeowners faced foreclosures and wealth destruction. This deepened societal divides and created long-lasting resentment. Third, the rise of zombie companies. In the aftermath, many corporations, burdened with high debt, survived only because they could borrow cheaply thanks to central bank policies, rather than because they were profitable. This inefficient allocation of capital stifles genuine economic growth. Fourth, the shadow banking system. While traditional banks were bailed out, the less regulated parts of the financial system, the shadow lenders, the complex hedge funds, often took the losses or simply changed their stripes. This created new, potentially riskier corners of the financial world, less scrutinized by regulators. And crucially, the hidden fragility remains. The debt that mutated hasn't gone away. It's just embedded in new forms. Today's inflation, while driven by supply chain issues and fiscal stimulus, is also a symptom of this underlying financial stress. When credit falters or debt burdens become too heavy, it can feed inflation. Market volatility is a constant reminder that someone, somewhere, is holding assets backed by shaky debt. The next crisis might not be a housing crash, but something else entirely. Yet born from the same flawed logic, we see echoes of 2008 in the sheer scale of today's debt, the complexity of modern financial products, and the recurring theme of hidden risk. The toxic debt didn't vanish. It adapted, and it's still there, ticking, waiting for the conditions to become toxic once more. So what is the lesson? That the 2008 crisis was a blip? No. That it was solved? Not really. It was a stark, brutal lesson exposed. Yet the fundamental problems of the pursuit of ever higher leverage, the illusion of safety through complexity, the belief in perpetual economic growth financed by debt, remain deeply embedded in our system. The debt that mutated in 2008 isn't just a historical footnote. It's a ghost haunting the financial architecture. It whispers that the promises made to fuel this system, the promises of safety, of growth without limit, of debt as a solution, are fragile, easily shattered by reality. We need to remember 2008 not just as a past event, but as a blueprint for ongoing fragility. We need regulators to remain vigilant against complexity and excessive leverage. We need investors to demand transparency. We need policymakers to recognize that the accumulation of hidden debt is a recipe for future instability. The question isn't whether the 2008 debt is gone. The question is whether we've learned its crucial lesson, that the system, built on this debt, remains fundamentally vulnerable, and the threat of hidden, mutated financial fragility is closer than we might think. So, is the threat of hidden, mutated debt truly behind us, or is it just waiting for the next storm to unleash its danger?